The do-or-die zone was officially broken as of Monday, and even with today's better-than-expected CPI inflation print, markets were unable to rally even just to the low end of the zone. There was no retest. We've got an abbreviated West Coast episode for you tonight, so kick back, relax, and welcome back to the Trade Brigade Midweek Show. As always, subscribe, check out all the stuff you see on the screen, and we'll jump right into this. I want to start with a zoomed out look just to reinforce where the do-or-die zone low is. Ultimately, it is the retest of this previous weekly breakout level, and the weekly 50 SMA is in here as well. This was the low of last Friday's session. And you can see, and if the market feels almost like deja vu, it's because the playbook has been Monday breaks the lower edge of the weekly expected move, Monday breaks the lower edge of the weekly expected move, Tuesday and Wednesday consolidate with an inside bar, Tuesday and Wednesday consolidate with an inside bar. Now, of course, the playbook looks the same, but the location here is really what matters. And it's the fact that it's taking place underneath the bottom end of the do-or-die zone. The do-or-die zone is ultimately this entire range right here, but the fact that we're underneath the low end, to me, is inherently bearish. Now, there's one interesting thing that we'll get to in just a moment, which is that the semiconductors actually put on a little bit of a display today with some semblance of relative strength, and we'll talk about that. But for the most part, you are still seeing red across the board in the S&P sectors. It doesn't feel like we've hit capitulation here in terms of finding a short-term bottom. I would really look at this as more so bear flag acceptance underneath the bottom end of the do-or-die zone. Now, even if the market were to take out, from a daily perspective here, the top end of the inside bar range, or the two-day balance range you could call it, the Tuesday and Wednesday session combined back-to-back here, if we take out the bottom end of the do-or-die zone and move back into the zone, what does this achieve from a trend perspective? Is there any change in trend here? Now, I'm purposely leading the question on to say, no, there's going to be no change in daily trend if there is a recapture of 564.65, the bottom end of the do-or-die zone. As we described in the Saturday update video, we were willing to give the market a chance to set a lower high anywhere underneath 590.25. And obviously, with the continuation on Monday, opening underneath 573, offering no semblance of a look below and fail. Remember, we had talked about that on Saturday. Maybe a counter trend move was available. Well, Monday's gap down instantly threw that out the window. So now that we're down here, ultimately with a close from today's session in the midpoint of the two-day balance range, there's even more room for a lower high. So once again, if the market was to produce something that looks like this, I would just be putting my thinking cap on and saying, great, what's the opportunity for that lower high now to be set here underneath 573? A rejection of the daily 200 SMA, this time testing from the bottom side up. That would keep us inside of the do-or-die zone. It would get us back into the weekly expected move. Not that that's the end-all be-all. It's just a suggestion from the options market. But it wouldn't actually change the daily trend. So 573 is the next big place where I'll be looking for a potential lower high to develop on a retest from the bottom side up now of the daily 200 SMA and the bottom end of the previous two-day balance range, maybe even three-day balance range if you want to consider Thursday at 573. Now, if the market was to start getting some price acceptance back above 573, it would raise my eye. I would be interested in that potential move there, but I still don't think that that's enough to change the trend. The last major lower high in the trend count, if you will, is really here at 584.75 now that we've gone on to really produce a much more severe lower low. So that's the quick daily analysis. We can come in here with a Fibonacci, and then we'll drop it on down to the hourly. We'll get granular here. If we do something that looks like, there we go, can we get a click, thinkorswim? There we are. The 38.2 Fibonacci, which would mean that this entire move is what we're analyzing, would classify, or any consolidation underneath 573 would classify as bear flag consolidation. So there's really no change from this perspective until there's clear price acceptance back over 573. So the key level walking forward, if you're trying to spot much more of a confirmed reversal from the market, is at bare minimum, you have to be back over the daily 200. You have to be back over 573, the multi-day lows from back over here. Let's take it on down to the hourly time frame chart and see what else we can glean from the market. So I would really, again, sort of encourage you to think about this from a playbook perspective. What does this look like? You know, that rinse and repeat, the symmetry of the market here. Now, it doesn't mean that the market needs to do the exact same thing Thursday, Friday. But the point being is, in a downtrend, what are the characteristics that the market typically displays? Well, any consolidation that's underneath a critical breakout level, or breakdown in this case level, is really nothing more on the hourly time frame chart than an opportunity for a smaller time frame lower high. So if this is bear flag, then, I mean, sure, a breakdown of the trend line maybe gets you back down to the lows at 8, geez, getting all the numbers mixed up here. That's what the West Coast will do to you. 548.75, right? That becomes the next target just for straight up continuation. If there is going to be the stronger counter trend, then this is primarily what we're looking for. And once again, I think it's reasonable that maybe the market offers risk reward around these zones here to provide a long opportunity. But at 573, it's just totally back to the bear side, saying where's the lower high and how do we use this now as overhead supply? Where's the rejection of the daily 200 SMA, which we were just talking about from the daily chart quite literally. So this is all making sense still as just bear flag consolidation and a very clean and developed now downtrend with plenty of momentum, right? There's plenty of range here to be trading for. Let's come in with the intraday anchored view apps just to check in on these and see how they've developed. Primarily, we're concerned about this one, right? The close on last Friday was fairly compelling for, okay, maybe there is look below and fail. As soon as we opened underneath, and you can see we're underneath the entire view app cluster at this point, the open underneath that immediately put any thoughts of a stronger counter trend to bed. It should have been, even if the market rallied on Monday, and we talked about this in the pre-market prep, any rejections here are just game on back to the equal low, if not seeking continuation. So this is all making sense. You're getting rejections here. I would say there's no reason to jump the gun on trying to look for this counter trend move into 573 until there is acceptance over this level, which is, again, the top end of the multi-day balance range that we've been dealing with from Tuesday and today's Wednesday session. To the downside, it does leave a little bit to be desired. I'm not convinced that the best short location is in this chunk of price action. I would prefer, in the current market context, to be shorting lower highs that give much tighter risk relative to the potential reward in the market. If you've been shorting the lows of this move, especially on like even smaller time frames, let's go to a 15 here. If you've been shorting into the lows, typically these pops have not been very friendly, right? Even here, as we breach to a new low of day, and we talked about this morning as CPI was coming out, the fact that the market was really failing to find much more momentum to the downside underneath the intraday lows, this pop just immediately sort of blew up in the face of new money shorts who are getting involved on the lows. So trade location in this market is incredibly important. And today we saw quite a bit of two-sided trade, down, up, and then just completely flat and sideways into the afternoon. So the opportunity to short the market is not so much on the lows once a breakdown has taken place, it's seeking the lower high. And I would just reinforce that here such that if we do move here, the idea is not to long this prematurely. The idea is firstly to be thinking about a lower high under the do or die zone. If the market is going to go on to produce the counter trend, it has to be, there's no ifs, ands, or buts about it. It has to be a very obvious higher low setup over the 564.65. So that's my take here. I still maintain that bearish stance. We can reinforce this with the market internals here. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. Even today, as we went sideways for two-sided trade, does it start looking like a stronger bottom is in force, or is it more so just like the market's been down aggressively, we're extended through the lower bound of the expected move, and maybe we're getting digestion? It's certainly the latter, in my opinion, right? If we're looking at the volume flows, very, very neutral, not even close to substantial. And this could be, on both sides. We'll keep an even-keeled approach here. One thing I will say is that this morning with the beat on CPI, especially with the way that some of these internals opened up, it seemed like an opportunity where if the market was going to try to latch on to any positive news, because it's not been very positive out there, we'll say that quite frankly. But if the market was going to latch on to any news, it seemed like this was the time to do it, right? We were opening over, if I just zoom in on the ES here, we were opening over the settlement price from the Tuesday session. Wednesday's open is up here. And it's not that this is like a substantial gap. We were still opening inside of range, but we were opening over the prior day's value. There was an opportunity for maybe a higher low and then a Brigade bolt out of the prior day's range, and just none of that took place, even with a potential positive catalyst here suggesting that inflation is still continuing to move in the direction of the Fed's target. Now, to the magnitude that they'd like, probably not, but it is still a step in the right direction. It's not a step in the wrong direction. You could frame it that way. So market internals on the open, specifically out of the advanced decline line, as well as the volume flows for the session, the fact that this immediately broke back down towards the lows to me, is just an indication that even with positive catalysts, new money buyers are not stepping up into this market. The volume flows through the session confirm that. The advanced decline line neutralizing to 0 confirms that. The index score here at -4 for the session confirms that. Like, that's the close, but look at the majority of the session. Even as this move off the low of day was taking place, the index score did not get positive. As we look at the cumulative build out of the tick, incredibly flat. It is not even close to positive 5,000, which would be our threshold for saying like, wow, okay, that's something to pay attention to. So nothing here is compelling to suggest that new money buyers are stepping up. We'll move over to the NASDAQ because in the interest of time, we're not going to get too detailed into the market profile and so on and so forth. We'll be back to the East Coast penthouse location number 1 at the, or I should say, the Saturday update video. This chart continues to be very obvious to me in the sense that the overhead supply is so well defined. As of Friday's close last week, we were already underneath the daily 200 SMA. Even if the market were to break over that Friday high, there is just so much room for the lower high on the daily time frame chart to develop. Obviously, this week we've gone on to produce a very substantial lower low. So even if the market rallies again, it's here. Right, and we're just watching that 492.50. As we look at the multi-day, it's not a balance, quite frankly, here in the, well, maybe it is if you count Monday as being the container bar. If you look at Tuesday and Wednesday, today's session, you're not really getting that inside look like we had in the S&P 500. So another example here where the NASDAQ, as maybe something that's more influenced by the tech sector, of course, just didn't have what it took to even get in gear to the upside, opening at the prior day's high. You can see the upper wick breached the previous day's high. This is a fairly compelling thing to make note of because if shorts were going to squeeze and kick off this big, like, shorts are panicking, oh my goodness, the short trade's not working out anymore, we've got to get rid of shorts, we might have to start thinking about longs. If that was the case, any break over the previous day's high should have ignited a frenzy of short squeeze to the upside. One of the concepts here to really lean into is the fact that we had one time framing. You can see that every single, well, maybe not every single, but from here, let's count from Monday of last week, where the playbook really begins. Every single daily bar sets a bar-to-bar lower high. Today is the first day where that actually stops. So the fact that we ended one time framing, and yet the market was unable to squeeze shorts off the dead lows of the move, does not strike me as like, okay, it's time to buy this bottom. Everybody's panicking on the short side and new money buyers are stepping up. It's just not the case. So let's come in here with our fibs from the top of the move. If we could get a click, that'd be great. Thank you. And to the bottom, the 38.2 loosely aligned with our daily 200 SMA, our 492.50 level. If we clear that up, go on down to the hourly time frame chart. What other nuances can we point out here? And again, think about this through the lens of today was the day. If there was going to be a counter trend move, where that should have or could have been more likely to take place. If you look at, in particular, the end of session on Monday, and then if you look at this, you could consider that, right? Look below and fail. The market rotated to the top, and now the next step was really just breaking out through these highs. The market opened over these highs. It was unable to find a higher low above. It looked above, failed back into the prior day's range, and consolidated sideways all day. Now, I'm not sitting here saying that it's impossible for the squeeze to take place tomorrow or the next day, Friday, but I am saying that generally the types of participants we're seeing in the market currently are not those who are going to move the market with any sort of major initiative here. It's totally either passive sellers or buyers, not even buyers, they're just not here. Passive sellers, and that's it. You have passive sellers as of this consolidation. You don't really have aggressive sellers stepping back in through the consolidation, but it wouldn't be unreasonable that that might kick back off on any sort of attempt back down here at 469.50. Why? Well, because this lower high continues the overall downtrend, of course, and then anyone who's looking at this classically, right, through the lens of, okay, bear flag breakdown, time to send it lower, in essence, it brings in the next wave of momentum sellers. Momentum sellers couldn't do it here, but if a lower high is set, we don't have new money buyers, any consolidation, you get wave two of momentum sellers. So underneath 469.50 opens the door. I think that still, like the S&P 500, I would echo the sentiment that trade location matters a whole heck of a lot here. It would be best, in my opinion, to set a lower high here, which would be a firm retest of this sort of inflection point that we've seen, reject the Monday high, 484, risk reward back down towards these lows, incredibly lucrative. Right now, it might not be the easiest sailing on this move, as we have a bunch of sideways consolidation to, quote, battle through. But generally, this lower high, risk reward wise, would be one of the more opportune trade locations to take advantage of. Even if the market rallies beyond that, that's that's probably where the stronger counter trend argument steps in. I don't know that just trying to long this in here makes the most sense. There's a little bit of a thin structure retracement, but what did we see today? Right? Buyers just aren't making it happen. So if you're trying to long this in here, you're kind of long in between the wrong zone. You're not really set up for proper risk reward there. I would say if it is going to be a counter trend long, and if you do want to participate in that, you would have to flip the 484 level, something that looks like this. Let's take a look through the lens of the intraday anchored view apps. You get a little bit more of a closure at the anchored view app here instead of a rejection like what we saw in the S&P 500, but nonetheless, 484 is being reinforced as a key rejection point for the market if there is any sort of attempt there. So first and primary thought is something along these lines for risk reward to the downside, the next bear flag to ultimately play out. Let's move along to the Russell. The NQ NASDAQ side of the market internals look almost identical to the S&P, so there's not much. Well, let's just go over it. Why not? This will take 2 seconds. We won't do a deep dive, but almost identical. You can see here, or actually, maybe I'm mistaken, and this is kind of what I get for not paying too much close attention. The last I checked in, honestly, was sort of in this area here. So it did make it, surprisingly so, up towards that 400 million. Generally speaking, not a compelling argument still for new money buyers stepping up. You'd really need a stronger move to 400 million paired with bullish activity across the tick. And remember that there is no index score that measures from the open here out of the NASDAQ, although it's almost 1-for-1 with the S&P index score that we've developed. Regardless, the tick here would want to be substantially over the zero mark to indicate that these volume flows are not just, it's not just, how would you frame it? It's being supported. The volume is truly up volume, not just volume that happens to be over the previous day's settlement, right? So because you can technically be over the previous day's close, moving lower, which is what the tick would sort of confirm here by being primarily distributed at the zero line, if not slightly above into the close. Nothing substantial, but slightly. It's not, even in this view, not new money buying. So good thing we did check in on this, just to clarify maybe if anyone would have had questions outside of that. The tick here, it's the combination of these things. So not really compelling for new money buyers still. It still appears to be a downtrend in my view. IWM, and then we'll quickly hit on some sectors, some high-level stuff, and then we'll wrap it up. Small caps, they've actually fared okay. It's mostly a 3-day balance range here on the lows. I would think that if you're looking for a compelling argument to go counter trend, meaning long, the S&P 500, you probably want to see a breakout over 204 on the IWM. Something that looks like this probably helps build the case that your S&P counter trend can take place in the first part. If you're just getting sideways consolidation without attempted breaks over the 204, I would sort of shy away from stronger counter trend arguments to the upside in the S&P. Reason being is that with a cooler than expected inflation print this morning, there's simply no follow through. The conversation we just had in the S&P about if the market was going to latch on to any good news, this is good news that should have been it. Small caps just didn't respond. Not even a little bit, right? Didn't even take out the lows of the prior range. It's not like we gapped up here and then faded off for this session. It's not like we popped an upper wick and then came back in. Didn't even attempt it. So if IWM is under 204, I would not lean into the long side aggressively on the S&P 500. I mean, we can look for a counter trend, but just understand you don't want to overstay your welcome on the long side. You can trade it, you can scalp it, that's fine, but the structure here is absolutely still bearish. Not much to glean on the hourly chart, I'm sure. It's just total sideways consolidation down here. 204 is key, and then, of course, 198. Small caps not helping the case for long in the S&P as of right now, but balance rules are ultimately in play. All right, sector-wise, I do want to spotlight the semiconductors here because if we take a look, it actually produced a bit of an indecisive doji over the prior week's balance low, this 219.50 mark. So this can almost act as a key for the remainder of the week. If semiconductors cannot hold up over 219.50 and fade back off into the Monday-Tuesday range, then you know the answer to the S&P 500. If you notice that semiconductors do end up opening on a gap up, or they're testing the prior day's highs, or they're trending out of the prior day's range, then it probably prevents stronger follow through to the downside just yet in the S&P. And putting my thinking cap on, I would just say, okay, well, we're probably trying to rally to set some sort of lower high, and the first base case is that we're shorting those lower highs, and only if this ends up turning into some sort of major reversal out of the SMH, which in my view has to be over 237. Remember that, this is maybe a good first baby step, but firm, it's like Dave Ramsey's baby steps, right? But a firm step, I don't know why that reminded me of that, but a firm step has to be, you got to get over 237. You got to get back into this overhead supply. Otherwise, any rally attempts, I wouldn't trust it as far as I could throw it at this level, 237 or below. So that's my take here out of semiconductors. I think it's an important spotlight. Another thing that I find compelling is the XLP falling off of a cliff. So defensives are not holding up as they were during the initial phases of the sell-off. So there is still that rotational aspect to the market going on. If you look at healthcare, it's the same thing, down big. Another one that's been substantially hit here is financials falling off of a cliff from a recent all-time high. Not to say that, everything's doom and gloom here, but it does not strike me that even on attempted rallies, we are out of the woods. There's plenty of levels I could think of, and you can see them here in financials where a lower high could be set. You can even take a look at the heaviest weight sector, the technology sector, which is just going to mirror what we saw out of the SMH, where here's your overhead supply. I wouldn't trust it as far as I could throw it, as long as we have this. The fact that this distribution had taken so long, and it's not just, it's a different story when at the highs you get a sharp pullback and then you're battling back in the upward direction. But the fact that the market had gone sideways for so long, and the classic comparison is just the Wyckoff distribution, right? If you're under that, that's a far more compelling case for a stronger top to be put into the market. Remember, tops are long, drawn-out processes. Bottoms are usually the emotional, everybody capitulates, oh my God, and then you start to work your way. So those are some comments about the sectors. A brief glance at some risk-on specialty stuff here. Counter-trend move in the context of a downtrend. I mean, we're literally just hardly off of the lowest lows in these trend counts. Same thing here in the ARK-K. Still looks like risk off in my assessment. As we look at interest rates briefly, even on the better-than-expected inflation print, rates are higher, and I think that's because the market did the job of Jerome Powell aggressively prior to the release of the number without really seeing too much progress prior. So not really a shocker over here, in my opinion. As we move maybe to credit spreads, just as a proxy, for volatility, this is risk off. This doesn't really bode well for equities down below. We can briefly glance at breadth as well, because breadth has contracted sharply this week. Look at the big aggressive downtick from week to week so far out of breadth. A more bullish market that's trying to find a bottom would simply not look like this. It would have attempted to hold up here and then make a move to the upside. New highs versus lows would have recovered. The fact that we're back in negative territory making a new low, it's not characteristic of a bullish market. So the perma bull of YouTube here is assessing the data points, and I'm continuing to update you based on what I'm seeing, and it doesn't look like a bottom is even in the conversation as of right now. Volatility futures are still in backwardation. Same thing here versus 9 and 30-day VIX. The one-day VIX, after the release of CPI, we opened on a gap down. So it doesn't shock me that the market moved higher in the pre-market on the release of the data, but that's simply a mechanic of volatility. The unknown is now known. Volatility comes down and the market rallies just a little bit. Now, of course, the market faded off of the actual cash open, but the volatility mechanic still held true with the gap down in the one day. So any semblance of like, oh, look through the pre-market, these new money buyers stepping up. Well, first of all, new money buyers don't typically exchange or interface with the market through the pre-market. It's regular trading hours only. And then secondly, it's just proven in the VIX. The gap down is what caused that pop to the upside. The unknown becomes known, and that removes volatility. So, and then market making reduces the hedges, so on and so forth. So it's purely mechanical. Point being is, in summary here, there's nothing about the market over the last couple of weeks, not even weeks, days, after Monday's break through the lower edge of the do or die zone that is overly compelling for, like, number one, we haven't hit a capitulation bottom yet. we're still seeing some degree of rotation across the sectors. So the big gut-wrenching moment is not here. The environment's still right for it, but the gut-wrenching moment just simply hasn't happened yet. And even if we do rally, it just seems to me that there's just an opportunity for a lower high to be set. So in summary, the market is still bearish, which may not come to a shock, or may not be a shock for some, maybe for others who are obsessed about trying to find a bottom. I'm not seeing it yet. And in hindsight, great, if this ends up being the exact low, come on back down to the YouTube comments section and rub it in my face. That's fine. But I would really prefer some degree of confirmation across all of, in the abbreviated session we've had together today, even in just this brief set of data points. I would much prefer to see some semblance of buyers stepping back into the market, and we're just not seeing the evidence just yet. So that's my abbreviated session for you tonight. If you enjoyed the shortened format, hopefully that's working for you. It's working for me on this Wednesday afternoon. I'm going to go enjoy the evening here on the West Coast. Hopefully you guys can do the same wherever you are in the world. And we'll pick it back up tomorrow morning for a session of the pre-market prep. It's quite convenient that everybody's still asleep when that takes place. So we'll do that again. We have PPI tomorrow morning. Come back on out to the show. We will have coffee and donuts for your enjoyment. And with that said, have a green trading week, and I will see you in the next one.